like the mock turtleneck.
Thank you. It's I bought this at Sears on clearance. When Sears was going out of business.
This was like 89 cents?
I think it was actually less.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
Welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and this guy is
Brian Leverage.
And you know what we do on the Old Fashioned Real Estate Show is we drink bourbon old fashions and talk about real estate investing.
Yeah, unless they've got water in them.
This is my fake bourbon old fashioned, but as our camera guy pointed out, it is the most old fashioned of beverages. The very first original beverage right here in my glass.
There you go.
If you're wondering why I'm not drinking today, it's because I'm doing a 40-day alcohol break for the Kind Morning Last Life Ever challenge. Brian, Are you doing that?
I'm not. No.
I didn't think so. I based that on the fact that you're actually drinking
bourbon
right
yes.
now. So we have an interesting.
I had 2 martinis at lunch.
Yeah, I know. Your assistant told me. And anyway, so we have an interesting topic to talk about today. It's very timely, and that is sort of a state of the market update for 2021 and the new presidential administration that just came in this week.
Yeah.
So, Brian, how do you feel about the real estate market? Should people be investing in 2021?
Yes, I think they should.
Great.
I think you should be investing, frankly, every year, though.
Okay, well, then we'll just wrap the show up there. No. Thanks for coming.
Yeah.
No, I agree with you. But what should we be concerned about? Inventory levels, for example. Like prices seem to have gone up a lot, at least in the markets that I follow. Should we be worried about finding the right deal?
Yeah, I mean, you still need to, whatever analysis you're using to determine if something's a good deal, continue using that. Now, you might need to adjust it, obviously, given factors like lower inventory and lower interest rates, which, by the way, in conjunction with low inventory, are driving higher prices. So, those are considerations you need to take into account. There's also some uncertainty is what's going to happen under the new presidential administration that just assumed office yesterday. To answer anything in that regard right now would be purely speculative. So not really doing our viewers a good service by doing that.
And maybe by the time you watch this show, you'll have a better idea of that.
No doubt.
But things like the eviction moratorium,
sure.
I think there was an executive order that came out yesterday already extending that.
Okay. There was a CDC moratorium that was instituted in early September of last year under the Trump administration that prevented landlords from doing evictions for non-payment of rent. However, that does not cover illegal detainers. So instances where landlords have non-renewed a lease, terminated it, and the resident or tenant stays in possession of the unit past the expiration of the lease, you can still proceed on those grounds. In Tennessee, where we are, unfortunately right now, you can't even get in front of a judge until sometime in April at the soonest because the Supreme Court here has stayed all in-person court hearings through the end of March.
Right, and of course I think multiple jurisdictions are dealing with various restrictions, but the point is, right now when you're investing in real estate, prices are up, inventory's down, but those things make it a little bit more difficult to invest, and then you have to sort of evaluate the risk of COVID. And how that's affecting your ability to proceed with your normal business operations. On the flip side of that, you mentioned lower rates. We're seeing stupid low rates right now, like the lowest rates in history. My first home mortgage was 7.25%.
And that was a deal then.
Oh, yeah. And then I refinanced it a couple of years later at 5.99%. And I remember saying to my wife, we're never going to see a rate under 6% again. I really remember saying that. So I didn't have a crystal ball then, and just full disclosure, I still don't have a crystal ball, but I do believe rates will stay low for the foreseeable future. There's a tremendous amount of stimulus being put in the market, and one of the ways they're doing that is by buying bonds and causing the rates to go down.
Yeah, so for myself personally, and everybody's different, However, I would tell you you always buy, right? Up part of the cycle, down part of the cycle. We're still clearly in the up part of the cycle, but having said even that, inventory is so low, there's usually something, right? Like a black swan event like Corona, for instance, at the beginning of last year, or something else that we're not even thinking about, right? That can cause a big market shift. But it doesn't even have to be a black swan. It could be just a normal economic correction.
Well, so we did a whole episode on this. I think it was episode 13, which we'll put up above us here, on market cycles and how you thought about the 4 different market cycles. And a quick reminder, you basically have expansion, hypersupply, recession, and then recovery. And it just goes in a circle. Those 4 things over and over again. If you had asked me a year ago, I would have said we were well into hypersupply. Supply was starting to go up. Vacancy was going up. But since the COVID crisis, we've seen a reversal of that, and we may have moved backward in the cycle, and we may have actually bought ourselves more time. Now, I know a lot of people are saying we're due for a correction at any point, and we could certainly jump right into hypersupply or recession very quickly whenever the eviction moratoriums or foreclosure bans are lifted. But it's really hard to tell because, like you said, it's a black swan event. We had Harry Dent on. We'll put that above us as well. Harry Dent said that we are absolutely due for a major correction in 2022. But we'll see if he's right. I don't know if he has a crystal ball or not. He's been predicting that for a long time. I'm sticking with my prediction that the market will remain strong for the remainder of the year. And now a word from our sponsors. Who's sponsoring us today, Brian?
Well, we are, Jeff.
We are. How
Yes.
amazing. So we want to tell you about how you can save an enormous amount of money on your taxes and how Brian and I have been able to eliminate our taxes entirely.
You guys need to learn about cost segregation, which you can do by going to our website, oldfashionedtaxsavings.com.
Yes, and if you go there and you fill out the form, you can get a free, no-cost benefit analysis that will show you how much money you can save and what it will take to do that.
And I think it depends on what strategy you're talking about doing. If you're a rehabber who flips houses or a wholesaler, where typically those are very short-term investment horizons, you might want to think a little bit harder on your secondary and tertiary exit strategies on those types of things. For instance, if they don't sell for what you think, what are they going to do as a rental or a lease option or so forth. In addition to that, if you're a buy and hold person, depending on what type of asset class, single family, I think you probably need to take a little harder look at too for those same reasons, because unfortunately, single family derives their values from comparable sales, whereas apartments and other commercial income producing assets rely on an income approach to valuation, right? So they're going to generally be stabler, certainly apartments will, than maybe commercial or retail, depending on what type of commercial asset we're discussing. You just got to take a look at all that stuff. If you're taking a long-term view towards things like, hey, I'm going to have this 5 to 10 years, I don't think you have a lot to worry about.
Yeah, I mean, we've said this before, but you buy whenever you buy, you only sell when it's high, right?
Yeah.
That's sort of my stock phrase when it comes to timing the market. But the reality is, if you have long-term debt in place, you have adequate cash flow, and you have adequate cash reserves, you can just wait it out. If you bought in 2006 and you had to sell in 2010, not great.
Yeah.
If you bought in 2006 and you sold in 2021, you're very, very happy.
Yeah.
In almost every market, in almost every asset class, you're going to be really happy with that. And so I think over the long term, if you can buy assets that cash flow and hold on to them, you're going to be fine. So the short answer, which was you should invest in 2021, remains true today. But with rates as low as they are, I would say putting long-term fixed rate debt is going to make sense in most markets. Another thing to consider is it's not just one market. I mean, what we're talking about applies very well here in Chattanooga. It applies in other markets that we follow, but each individual market is, different. If you have a single employer in a market and that employer goes away, that market may never recover. So you don't just invest and hope it works out. Do your due diligence. figure out if you like the long-term demographics. I mean, I just saw, which is an argument for investing in Chattanooga, that the U-Haul reports came out last month or last week, maybe 2 weeks ago, saying that Tennessee is the #1 state for new U-Haul
for last
people
year.
moving in for the year 2020. More people moved into Tennessee than any other state in the union proportionate to population, which means we should continue to see growth here. And obviously, if you are investing in Chattanooga, then you'll benefit from that.
Yeah. And I think something else to add to the conversation is inflation, right?
Sure.
Costs go up over time, and that compounds. So I think you can make the argument that despite market fluctuations, again, taking a somewhat medium to longer term view of things, whatever basis you get into, it doesn't matter if it's a house, a duplex, or an apartment today. Again, if you're investing in a healthy market, where
Right.
there's future population and job growth, as opposed to a declining one, it's almost guaranteed that whatever your basis is in that property today, it's guaranteed to be higher in the future.
Yeah, and I mean, it's almost guaranteed, right? But Harry Dent actually talked about this as well when we interviewed him, and he said over the long term, real estate prices almost exactly mirror inflation.
Yeah.
So while you do get spikes up and down, if you average it over 50 or 100-year periods, it's going to mirror the rate of inflation. And what we do know right now is in 2020 and now in 2021, there's been an enormous amount of stimulus money pumped into the economy, and that is likely to cause inflation. And I would say that, the best hedge against inflation is having assets that go up with inflation.
That's right.
All right, well, listen, I don't know if you have any other thoughts
No, I'm
about
done.
investing in
Yeah.
2021. Great. So that's it for this episode of the Old Fashioned Real Estate Show. I do want to remind you, however, we did an episode on cost segregation, right?
Mm-hmm.
So this is a little mini commercial at the end of our show. And we have partnered with Terry Judge and Core Solutions Group to offer cost segregation services to people that listen to our show. So if you want more information about that, you can
right here.
right there, or you can go to oldfashionedtaxsavings.com where you can sign up for a free no-cost benefit analysis. So with that, I hope you have a wonderful
Thanks,
day.